So in this video, I will not only give you the 3 best Canadian dividend ETFs for regular passive income, but I will also tell you which ETF is good for your portfolio based on the company you hold. I will also compare all 3 of them at the end of this video. So the third ETF, which is my personal favorite, you will get $422 in dividends. You will be paying only $11 for the $10,000 investment in the ETF. So we will mainly focus on these 3 points for the ETF. The first one is the dividend yield of the ETF. The second one is the management expense ratio, and the third one is if it is a good fit for your portfolio or not based on the holdings. So the first ETF I want to talk about has the 12-month trailing dividend yield of 3.88%, meaning if you would have invested $10,000 over the last 12 months, then you would have got around $388 in dividends, and the ticker symbol for this ETF is XDIV. The current distribution yield of this ETF is 4.04%, meaning you will get around $404 in dividends if you invest $10,000 today. The distribution frequency is monthly, so you will get around $33.6 every month investing $10,000. It also offers DRIP, which is dividend reinvestment plan, meaning you can buy the same ETF with the earned dividends without any additional cost to you. So the price to earning ratio of this ETF is 12.93, which is acceptable but slightly on the high side considering the holdings are not growth stocks. Price to book value is 1.73, which is acceptable. Remember, low PE and low PB ratios are good for us as an investor for long-term capital growth. Now, the most important thing, management expense ratio is 0.11%, which is very low and favorable for compounding growth. You will be paying only $11 for the $10,000 investment in the ETF, so management expense ratio should be as low as possible. If we subtract this expense from the annual total dividend of $404, then we will get net of $393. So the other very important point is holdings of this ETF. So the total number of holdings of this ETF is 21, out of which these are the top 10 holdings. Manulife and Sun Life Financials are insurance companies, whereas Bank of Nova Scotia, RBC and TD, as you know, are the bank stocks. In terms of sector exposure, 51.63% is financial holdings, communication and utilities are the second and third respectively. This portfolio is rebalanced every 6 months. So to simply explain, if you are not holding more of a Canadian financial stocks, including bank stocks and insurance stocks, then this ETF is definitely worth considering to get exposure to Canadian financial stocks. However, if your portfolio already has a good chunk of similar kind of stocks, then don't invest in this ETF, because the main purpose of this ETF is to diversify your portfolio. If we see the past performance of the ETF, then the average annual returns are 8.85%, which was slightly lower than the benchmark. However, if you don't want to actively manage your portfolio, then these returns are good along with the dividends. So in a nutshell, if you want the exposure to Canadian bank and Canadian insurance stocks and monthly passive income, then with 4% dividend yield, very low management expense ratio, and with stable and reliable company holdings, this ETF is definitely worth considering. Now, before revealing the second ETF, if you want to directly invest in the bank stocks, then you can check out this previous video where I have compared big 6 Canadian banks on all the important metrics. Now, the second ETF I want to talk about is XDV and is designed to track the performance of Dow Jones Canada Select Dividend Index, which includes Canadian companies that have a consistent track record of paying dividends. The last 12-month dividend yield and the current distribution yield for XDV is 4.13%, meaning you will get $413 in dividends if you invest $10,000 today. And the amazing thing is that the distribution frequency is monthly, so you will get $34.4 every month investing $10,000, and it also offers TRIP. So the price to earning ratio of this ETF is 10.94, which is acceptable for a dividend focused ETF, and the price to book value is 1.6, which is again acceptable and low compared to the previous ETF XDIV. Remember, low P and low PB ratios are good for us as an investor for the long-term capital growth. So the management expense ratio for this ETF is 0.55%, which is moderate. However, it is slightly high compared to XDIV's 0.11%. So you will be paying $55 for the $10,000 investment in the ETF. If we subtract this from the annual total dividend of $413, then we will get net $358, which is lower compared to the $393 of XDIV. The total number of holdings of this ETF is 30. Here are the top 10 holdings of this ETF. Out of these 10, 6 holdings are of the bank stocks with highest weightage of CIBC Bank. In terms of sector exposure, 55.84% is financial stocks holding. Communication and utilities are the second and third respectively. This portfolio is rebalanced annually. Again, if you are not holding more of a Canadian bank stocks and insurance stocks, then you can consider this ETF. If we see the past performance of the ETF, then the average annual returns are 6.42%, which was slightly lower than the benchmark of 7.01%. To sum up, if you want the exposure to big 6 Canadian bank stocks along with some telecom and utility stocks with low volatility and good dividend yield of 4.13%, you can consider this ETF. Monthly distribution frequency, moderate management expense ratio, reliable and stable company holdings. This ETF is more or less similar to XDIV. However, the key difference in this ETF is the holdings. So the third ETF, which is my personal favorite, tracks the performance of FTSE Canada High Dividend Yield Index, which includes Canadian large, mid and small cap stock. So the ticker symbol for this ETF is VDY. The last 12-month dividend yield and the current distribution yield for VDY is 4.22%, meaning you will get $422 in dividends if you invest $10,000 today. So the price to earning ratio for this ETF is 11 and the price to book value is 1.7, which is again in acceptable range and in line with the other ETFs. The management expense ratio is low, around 0.22%. It is high compared to XDIV's 0.11% and low compared to XTV's 0.55%. So you will be paying $22 for the $10,000 investment in the ETF. If we subtract these from the annual total dividend of $422, we will get net $400, which is highest among these 3 ETFs because XDV's net dividend is $358 and $393 is for the XDIV. So VDY is paying $400, which is the highest. So the total number of holdings of this ETF is 47, which is the highest of 3. These are the top 10 holdings for this ETF. Out of these 10, 5 holdings are of bank stocks with highest weightage of RBC Bank. In terms of sector exposure, 55.7% is financial holdings. Energy and communications are the second and third respectively. One of the key differentiator for VDY is that it holds 26.8% of energy stocks, which significantly high than XDIV and XDV. And you can see that difference in the past performance. So the average annual return are 9.75%, which is considerably high compared to XDV's 6.42% and XDIV's 8.85%. In a nutshell, high dividend yield, low management expense ratio, higher annual average returns with stable and reliable company holdings, it is definitely one of the best ETFs for monthly passive income. So if you believe that along with the financial stocks, energy companies will perform good in the future, then this ETF is best out of all three. So now let's compare all three ETFs. So the highest dividend yield is 4.22% of VDY. The lowest management expense ratio is 0.11% of XDIV. The highest net annual income from the dividend will be from VDY, around $400. As of now, the average annual returns are highest for VDY, around 9.75%. But keep in mind that this is the past performance. In the future, the picture could be different. So thank you very much for watching this video. If you like my content, please do like, share and subscribe the channel. If you have any questions, feel free to ask me in the comment section. Please consider that this video is just for an educational purposes, and please do not consider it as any recommendation.